Hey, it's Jim, and this is FRM Part 2, the topic on operational risk and resilience, and the chapter on risk reporting. The first sentence or two inside of this chapter clearly tells us that we're in the fourth stage of operational risk and resilience, but that sentence tells us that it's both reporting and monitoring, so we added the "and monitoring" in yellow, even though the chapter is called reporting. And note, when we go through these learning objectives, there are lots of words that sound like reports or reporting. In fact, there's one in each of these learning objectives. But we added the "and monitoring" there to the title of this chapter because we didn't want you to forget about the monitoring. And this will come up as we go through the slide deck. So let's go ahead and start with that first one, identifying roles and responsibilities. So look at the very top. We're trying to figure out who is the target audience for us to report to and monitor. So we have internal stakeholders. You know all these people and all these different bodies inside of an organization. And then externally, we've got all sorts of people on the supply chain. Remember, supply chain can go this way, supply chain can go that way. We have clients, we have regulators, and government agencies. Now look at the very bottom arrow point. Each audience has a different role and interest in monitoring the operational risk. So there's that word monitoring, even though it doesn't really appear in the title or any of the learning objectives. Let's go ahead and start with the board of directors. We've had this conversation multiple times, but it might be worth repeating. So what does the board do? Board has essentially two functions. One of those functions is to, and I'll just take this right out of like a Management 101 textbook, board of directors establishes the strategic direction of the business. That can mean lots and lots of different things. But the second function is to hire and fire the executive leadership team. Now, inside of that first function, of course, is the risk management function and the framework in establishing risk management principles, and we've talked about those in previous recordings. So let's go ahead and start with the risk committee of the board of directors, and of course this committee is focused on risk. So of course board members ought to have some experience, some skill set, some education in managing risk, which tells us that these board members ought to have gone through the FRM program so they know all that we know up until this point. But let's go ahead and try to figure out what kind of exam questions that might show up here. I want to skip ahead. So notice what we're going to do here. We're going to do audit committee and we're going to do executive committee. So think about potential exam questions, which might sound something like, hey, here in the question stem, we have a committee and let's suppose evaluates the company's risk management processes and monitors their efficacy, right? So then which of the following committees, A, risk committee, B, audit, and C, executive committee? You see where I'm going with this. So those are probably really, really good questions. So my advice is to really focus on the arrow points going down the left-hand side as we go through these next handful of slides. So the first one, that's probably an obvious one, right? Overseeing the entire organization's risk management activities. We already talked about evaluating. We talk at length in other readings and recordings about advising senior management on how best to approach potential risk. So let's take an obvious notion here. Here we are, financial institution. Clearly we're exposed to interest rate risk. And a key risk indicator might be something like, the duration of our assets versus the duration of our liabilities. And so we have this interest rate risk. How are we going to approach this? How are we going to manage that? And of course, we spent lots and lots of time about matching duration and dynamic hedging and all that kind of stuff. But advises senior management here in this context is probably not getting out an Excel spreadsheet and saying, here, look, here's all the possibilities, here are all the choices, here are all the options, here's what you can do. This advising senior management is probably going to be related to the risk culture, to what the chairman has led the board of directors in terms of risk capacity, in terms of risk tolerance. We have a slide on that later on in this particular slide deck. But the advises senior management is probably going to be on a more specific, a more global level, and allow the senior managers and then, of course, their individual silo team leaders to kind of figure out what that means using futures contracts or whatever it is. Analyze risk reports, that's probably an important one. And so think about this risk committee receiving all of these reports and then deciding which one is a serious enough issue so that it escalates for a presentation to the full board. Think about it. If we have duration of assets of one number, say it's 5, and the duration of the liabilities is another number, say it's 10, some crazy numbers like that. What if the risk committee has just read a risk report that says something like, hey, we expect inflation and interest rates to spike over the next 12 days. Oh my goodness gracious. So, well, that's going to be terrible news for, one side of our balance sheet. So we need to figure out, is that a serious enough issue to bring it to the full board, which swings back to the skill set and the experience for these risk committee members. All right, moving on to the audit committee. Now, what do we know about the audit committee? If you look at any kind of a description of what the audit committee does, they usually do kind of 3 kinds of things. The first one is to ensure that the financial statements are, accurate and of high quality and representative and all those kinds of words that we learn from the accountants. The second function is to make certain that we file all the necessary forms with the SEC and with government regulators and whoever else is out there interested in our reports. But then the third thing is some kind of additional layer of operational risk oversight. So that's probably one that might get forgotten inside of this entire bureaucracy, but I think that's probably a really good exam question. So remember, additional layer of operational risk oversight. There's the internal audit activities. There's received findings. There's regular audits. There's reports to the executive committee, which we'll talk about here in this very next slide. The members of the audit committee ought to also, now the chapter says something like, may also, and I'm of the opinion that more board members is probably better than fewer board members. And no matter what the company, whether it's a financial institution or a pharmaceutical company or an energy company, I'm in favor of having multiple accountants on the board with different kinds of experience. Then you have that experience, and maybe one or both of them can then serve on the risk committee. Now, the executive committee is charged with the task in general of saying something like, all right, if the executive leadership team needs to talk to the board, they can't talk to the entire board, they talk to this executive committee. And so this the big charge for the executive committee is to make decisions, important decisions, in between board members. There's the second arrow point there. Decision making between board meetings prioritizes issues. Now, I tell my students this all the time. Maybe I'm exaggerating and embellishing a little bit. But I say, look, when you guys grow up to be super successful, you want to be on the executive committee of a board because you will have access to the private helicopter or the jet. Because if there's an important meeting that's to be done, it's the executive committee that flies into headquarters immediately and then decides, is this warrants the inclusion of the entire board. And so you do lots and lots of traveling, and it's super fun stuff, if that's the kind of stuff that you're interested in. But here's the good potential exam question. Notice what we did is put these in red. So effective execution of the organization's risk management framework. Now, we've spent lots of time here in part 2 talking about risk management frameworks. And so all that stuff from our previous recordings. But notice what we've done down at the bottom. We've also highlighted the significant pieces of information that the executive committee ought to have, things like culture, things like status of issues, things like action plans, but also risk events. One of those risk events I just described earlier, right? Duration of the assets, duration of the liabilities. Suppose there's a spike in inflation. How do we manage that interest? How do we manage that interest rate risk? Is that a risk event? Well, of course, this executive committee will have the experience to be able to say, you know what, we don't really need to worry about it, but oh my goodness, we need to bring the board in. And then finally, this target audience goes down to, remember, I always use the term silos. Hopefully you guys have watched some of my earlier recordings. So you have these different kinds of silos, business line managers, business segments, call them what you want. Notice that up at the top we have this term risk champions. And, sometimes people use the word risk champions. Sometimes they use the word chief risk officer. We found out in the relatively large banking industry that there are some financial institutions that at one point in their history don't even have a risk champion or a chief risk officer. But look at that first arrow point there. This is important. Monitoring the status of those key risk indicators. So that's super important that each of those silos knows what that is. So remember, let's go ahead and do this. Just hopefully I'm not offending you, but what do we have? As a financial institution, we're generally exposed to, boy, do I want to say 3 kinds of risk, market risk, which includes interest rate risk, by the way, which what I was just describing earlier. Then credit risk, which is, that big umbrella that includes things like default risk and third-party risk, and then operational risk. So this is what we're doing here. These key risk indicators inside of our operational risk. So a key risk indicator, it might be what I was saying earlier about the 2 durations. It might be value at risk. It might be something else. But then notice what these people are responsible for. We need to look upwards, right? Up to, well, let me just go back here. We need to look upwards to these committees of the board of directors. What has the board decided? And then we're going to implement, all right? So that's the second one. That's probably a really good exam question. Implement the operational risk management strategies. Now, I want to remind you guys that we spent some good time talking about the board. We talked about risk culture. And I said to you in previous recordings that, it's up to the chief executive officer and the chairman of the board to establish a DNA in the brain, maybe we can call that risk culture, but a DNA inside of the brain where everybody is thinking, at least in some fashion, about operational risk management strategies and how to evaluate them, how to ensure compliance, how to provide the most efficient feedback so that what flows down, you have this from the board all the way down here to the silos, what flows down are not like snowflakes and that they just disappear. It's like icicles, they fall down and they stay on us for at least a while and then they melt and then they go inside of us. That's a terrible analogy. But you get my point that if that risk culture is established, then as these silo managers, 1, 2, 3, 4 arrow points, this stuff here is going to just flow seamlessly. All right, look down on the bottom right. We have this operational risk committee, which is focused from either this, here, let me go back here real quick, either the risk champion or champions or the chief risk officer so that it is centralized. And this comes once again from the chief executive officer and the chairman of the board. And so this operational risk committee is going to review the reports that come from this operational risk function, which is over on the left-hand side. So notice some of this data here: risk events, risk exposures, key risk indicators, action plans, modifications. And you see how these two, the function and the committee, they operate in unison. And then the result is this outward flow of information. Well, maybe it's outward and maybe downward to these individuals here and these groups of individuals, and then upward to the board. Now, there's a really fascinating part of this chapter on the reporting cake. And this is where I believe that GARP has started to focus in here on the monitoring stuff. And so look at the bottom, there's a cake with one layer, and then there's another layer, and then there's a top layer, so it's kind of like a wedding cake. I really don't know. I can't even remember what my wedding cake looked like. Gosh, I hope my wife's not in the other room listening. I'm going to have to go and take a look at a picture of what our wedding cake. I was just so happy that day. What did I care about the cake? But anyway, so it's a cake like this. So what happens? So look down at the very bottom left. So these risk champions and chief risk officers and business line managers, they are operating inside of each one of these silos, so they know what kind of risks are out there. They know what those key risk indicators are. So think about, if you do a search for key risk indicators, you get, millions of these things for individual businesses. And for most of these businesses, a key risk indicator frequently is the time between two events. And so for our financial institution, it could be a simple example of the time from, let's say I walk into the bank and I want to take out a $100,000 loan for whatever reason. What's the time between that request and the actual granting and distributing of the $100,000 funds? So that's a key risk indicator. If it's 10 years, then we're probably not doing this the right way. If it's 10 minutes, then we're probably not doing it the right way either. So there's an optimal time period. And so these silos then they know the time between, and there's sometimes the time between is seconds, sometimes the time between might be weeks or even months. So they have all of this information, and so the silo or the business line manager then gathers all this information and then decides what's important. So here we go, we move up the cake to the Operational Risk Committee. They're provided with information that they need to act on. Like if the minutes is this much, and we want to say, it's 7 minutes in between these two events, we think the optimal should be 8. Well, we could probably do that at the silo level. But if it's 7 minutes and we think it should be 27 minutes, well, then we push that upwards, up the cake, right? And so that we act. And then that goes up to the executive committee and probably the risk committee only with the information that they need to make that decision. And so there's the cake. Look at the second diamond point. Reported to higher level decision makers, while less pertinent data can be filtered out and kind of figured out on its own. Now, here's a little bit of a summary of what we've been doing. What the chapter does is go through a couple of these items here, some in more detail than others. This is pretty much the rest of this chapter. There's an example in the chapter on top 10 risks and risk outlook. There's a heat map, and we did a heat map in one of these recent recordings. There's key risk indicators. There's issue monitoring. So there's that word monitoring. We'll talk a little bit about incidences and near misses here in just a few minutes, but I want to go ahead and start with these top 10 risks. And let me just quickly go through these. And this is an example. And the reading is really kind of interesting. And it says something like, these are general and they do not apply to one specific bank. So if any of these things look familiar and you're reading about it in the Wall Street Journal, please know that we were not talking about any specific financial institution. Start with staff shortage up there. And so here's this top 10 risks. Staff shortage. Now, what the example that the chapter gives us is having a senior manager unable to attend meetings for some time period, for whatever that reason. So there's supply chain issues, there's third-party failures. Suppose that a third party goes bankrupt. What do you do? Well, clearly there's a risk outlook and an action plan, or at least there ought to be. And then money laundering, that's always a fascinating topic because it shows up in movies all the time. And I've said this to you before, I'm a voracious reader, so I read all the time fiction novels about money laundering. There's trading risk, we know about that, internal fraud, model error, and then mis-selling. Mis-selling, that's kind of a poor choice of the word. Mis-selling means that you sell when you shouldn't have. I can't remember if this is the example I read in the chapter, or if it's just something that I've known for some time. Like if you have a client who comes in and says, "Hey, I'm 22 years old. I am not interested in getting married anytime soon. I don't have any children, and I don't expect to have any children." And you sell them $27 million worth of life insurance. So that's the example of mis-selling. So what is this? Top 10. Look on that left block point there. These are specific types of operational risks that require the most consideration. Maybe this comes from the old David Letterman top 10 lists. Maybe it comes from Moody's, AAA and AA, and wherever it comes from. I'm always of the opinion that when we say top 10, is that more important than top 9 or top 11? But clearly, as the chief risk officer, you're going to have a top, I don't really know, 25 or something like that. And those ones that might be from 8 to 25, they might not be too terribly important, but you got to keep track of them because they might bump up into the top 10. Here's a super quick reminder of this heat map. This is a measure of the relationship between likelihood right at the top and impact. You should remember this from a previous recording. Notice that the second block point reminds us this risk register lists all operational risks that were assessed in that risk control self-assessment. Remember that model that we talked about recently. And so what are we most worried about? We really don't care about very, very low probability events that are going to have a low impact. That's the bottom left. What should we worry about? Those very highly likely that have extreme impacts. Well, of course, we're going back to our 3 general types of risks. We can do a heat map for market risk. We can do a heat map for credit risk. And of course, here's the heat map for operational risk. Now, here's this little illustration I was telling you earlier about. Notice there's our risk capacity. So think of risk capacity as we have these different silos. We have derivatives trading, we have retail banking, we have ATMs, and we have whatever that is that we have. So the risk capacity is the capacity that we are exposed to with all of our business operations. Well, we need to manage those risks, right? That's all part of this particular topic. So there is a risk appetite, and that comes from the chairman of the board and the board of directors. And there's our risk tolerance. So appetite and tolerance, remember, those are two different things. But what we need to do, look at the very top block point. These metrics are indicators that determine if we are operating within its risk appetite. So here's the good exam question. The question stem will say something like, well, I could just go back here. Let's just do this, right? Let's say something in the question stem, pick one of these 10, and somewhere in there, there'll be something about, hey, the board says, here's our tolerance, here's our appetite. What do you think about this? And so the choices would be, we're within our reasonable range of risk tolerance. Yeah, here we go. There's another slide with the word monitoring. So these key risk indicators, what we've talked about. Now remember, they can be quantitative or they can be qualitative. And don't forget that we're going to look at these in their absolute nature, but we're also going to look at them in terms of their relative nature and over time. So here we are. Are we fishing? Are we pulling on the lever? What are we doing? Low to high down there. The example that we got from the chapter, documented IT issues. Now, I said this just a few moments ago. Incidents and near misses. Boy, oh boy. You guys know who the great John Wooden is. the basketball coach for UCLA, won multiple, how about double-digit national championships in the 1960s and 1970s. Those of you who are basketball fans, please tell me you know who John Wooden is. John Wooden says something like, hey, you know what? Most people think that the teams that make the fewest mistakes over the course of a season are the winners in general. And John Wooden says, no. I want my team to make mistakes. That means they're active, they're doing. I want them to make mistakes so that they can learn from it, et cetera, et cetera. And that's really such cool advice. Maybe that's why he won 10 or 11 national championships. But that's what I'm talking about here. My analogy with basketball and the near misses. I mean, clearly we make mistakes and we have incidents. We have losses. We mismanaged our value at risk. We didn't match the duration of our assets and our liabilities. So we have these incidents. But then we have near misses. Or we have these close calls where we said, oh my goodness gracious, thank heavens that this happened or this happened or this happened. So then we can say something like, we have all these incidents, however many there are, but then we probably have way more near misses. And this is the John Wooden contribution to the FRM program. Excuse me, those near misses, learning from those near misses are just as valuable as learning from the incidents. Now, what do we do once we have an incident or a near miss? Well, we need to have an action plan. We need to have detective controls. We need to have corrective controls. I think we had this on a slide in a previous slide deck. And so what's the key word? The key word in the left-hand side there, from my perspective, the key word is to anticipate. When I read the Wall Street Journal, whenever an event happens, somebody inevitably is interviewed and they say something like, oh boy, we could have never predicted this. Politicians say this all the time. Oh boy, how in the world were we supposed to predict this? And I'm always thinking, wait a minute, this is what we're being paid to do. I mean, high level of compensation as a chief risk officer, we're being paid to anticipate. So when you wake up in the morning and you anticipate all of the bad things that can happen with market risk or credit risk or operational risk, then you can design strategies to avoid, to manage, to transfer, and to ultimately reduce. And that comes through detective controls and corrective controls. Now, I said this to you before. I have a colleague at school. Actually, he's retired recently, but he's a supply chain and operations dude, and he is super big on this term. He always says N-scan, scanning the environment. And what he means for scanning the environment is what this chapter calls horizon scanning. Right? So it's just a little bit difference in terminology. So my colleague would like to, he says, I wake up in the morning and I do an N-scan, but we'll use the term horizon scanning where we look out. Where are we looking out? Well, there's the environment out there, and that has a specific meaning, of course, with climate change and pollution and all that kind of good stuff. Then there's legal, there's tech, there's social, there's economic, there's political. And so, I want to go back here. Yep, I want to go back here. What are we anticipating? So this horizon scan is we're going to look out and see what could possibly go wrong with each one of these balloons that are outside in the horizon. And so what this does is that this allows the chief risk officer and all these committees that we've talked about so far in this slide deck a better understanding of the entire environment. Okay, so this is super important here. The horizon scanning is going to allow us to anticipate all of these problems. I mean, think about it. Go down to the bottom right, and I'll date myself here as a 61-year-old, with social. When my wife first got a phone, you could text, but you had to text with the letters underneath the numbers, and it was so strange. And I told my wife this. This is 20 years ago. I said, "There's no way that I'm ever texting. I refuse to do it." That's how wrong I was. Now, the end of this chapter gives us some statistics here, and I wouldn't really worry too much about the statistics. I would worry about the described challenges here with the data. So what I want to do is look at the teardrop points over on the left. Operational loss data generally doesn't follow a normal distribution because a small number of events generally dominate. And that's what the blue box tells us over on the right. So severity of loss per size, so 10 million euros or greater makes up about 2/3 of the losses for financial institutions. And then if you look down 5 to 10, 1 to 5, $500,000 to 1, keep going down. I mean, I'm not going to say that those are about the same, but they're clearly almost about the same. But if you take the mean of all of those that are about the same, and then you add the excess over there in the 10 million loss, which is this big loss, well, that tells you that the distribution is not normal. So the exam question is probably that first teardrop point. We need to worry about skewness. Maybe we also need to worry about kurtosis. We'll talk about that here in just a second. Here's another blue box that says something like, look, 20,000 to 50,000 euro. Boy, that makes up almost 60% of the frequency. The excess of 10 million, I don't even know what that little thing is there. What is that, 1 or 2%? So once again, going back here, the skewness and maybe kurtosis in these in the distribution. So what can we do here? So large risk events and too many small losses. Are you ready for this? These are probably really, really good exam questions here. Large risk events immediately escalated to upper management, then escalated up to the board of directors, and then escalated up to whoever's way up there to make that final decision. That makes perfect sense. I mean, think of a large risk event as September 11th. Think of a large risk event as the 2008 financial crisis, the COVID, et cetera, et cetera. Now, the cool thing about this flow here is that at each level, we're going to have some kind of reporting, and then, we can have lots and lots of detail down here. And as we move up, we narrow it down to get to root cause. Boy, we spent some good time in a previous recording on root cause, and then how to manage that root cause. I mean, remember, root cause analysis, we're trying to find the primary reason that an event occurred, and then what action can we take that's going to remediate that impact so that we can lessen it, right? Remember, I gave you the example of Tylenol back in 1980 or 1982. Too many losses. What are these? Human errors. Yeah, often attributed human errors caused by manual processes. That's why we're moving away from humanity and moving into machine learning and artificial intelligence. I got to go ahead and take a break here and just remind you, whenever we go into the machine, that means that we're one step closer to what happened in the Terminator movies. What are some other good questions about these too many losses here? Regularly detect patterns. Oh, yeah. So this is super important. Remember in your quantitative methods days, wherever that was, you did some time series analysis. In the time series analysis, you're trying to find patterns, patterns within a silo, patterns that are correlated to other silos, all sorts of relationships between and among. So that's important. If the losses are random and structurally limited, then they can, pass through to customers. Now here's a super simple, what might appear to be a complex slide, but it's really not. It really says something about the difference between what I was saying earlier. We'd have to look at these at the absolute level. So here's an example of $1 million. So project A and project B, we've got this operational loss amount, $1 million. Well, does that sound like a lot? Well, by itself, it may or may not be it may or may not be a lot. What we need to do is compare it to, in this first series, expected synergies. And so what we're saying is that we might lose this amount, but we might gain this amount. So, there's the check mark over there. That's probably good risk management skills. But if we have a project that has operational loss of $1 million and no synergies, well, that's probably going to be something that we want to move up into that cake. that we talked about earlier. And then project C and D, this is the whole relative. Let's compare it to something else. And when you do that, you take a ratio. So look at the second diamond point there, expressed as a percentage. There's the ratio. Total income, project budget, basis points of capital, revenues, expenses. I mean, you can throw anything in there that you want. Now, this is what I was saying earlier here. When we compute these operational losses, the average is unreliable because non-symmetric, higher variance, outliers, clustering. All right, so what's the better alternative? Look down at the third diamond point. Let's take a look at the median. Let's take a look at the first quartile. Let's take a look at the third quartile of the distribution. So that's a really, really great exam question where the association says something like, here's a bunch of stuff. Here's the average, and then here's the median. Which one would you rather use? And so you pick the median, and then they say something like, oh, hey, here's a standard deviation. What would you rather pick? Maybe the difference between the first and third quartiles might be better. And there's some examples here that we have in the table. And here's just another super simple slide that says something like, the average of A and B is the same as the average of C and D, but maybe they're not necessarily equivalently rated as a 3. So all we're saying here is that these ordinal rankings, they might be unsuitable for arithmetic calculations. So what do we try to do? We try to convert these to monetary accounts. We try to make certain that we group these indicators or these risk scores by category, and we try to, make them into worst and best and least and most and all that kind of stuff. So here's that last one, the best practices. The association is very interested, like other organizations are, and what are the best practices? So what kind of information? So qualitative data, aggregate historical losses. Over 10 years, I'm okay with 10 years. But again, I'll say, what's the difference between 9 and 11 and 10? And then business indicators and those necessary subcomponents. So the absence of evidence is evidence of absence. That sounds like a cool thing to say, but really what it tells us is exactly what John Wooden was trying to say to us, at least implicit. We're out there on the basketball court. We're trying as hard as we can. We're overplaying. We're trying to get steals. We're blocking out, trying to get rebounds. So inside of the financial institution, we're trying to manage, our market risk, our credit risk, and our operational risk. And let's go ahead and decide, are we doing these steps along those lines? Look at that last teardrop point. The firm should notify the regulator of significant operational events. And so finally, reporting to market and investors, what kind of words do you think we ought to use? Transparency, honesty. Boy, we don't want to unnecessarily alarm shareholders or bondholders or any other of the stakeholders there. For banks and financial services, right, financial risks are the bulk. That makes perfect sense. How about reporting on operational resilience? There's some new rules coming up here, March of 2025. We're going to be forced to report on operational resilience. Now we have this 3-year transitional period. And that takes us through risk reporting and monitoring. So thanks for watching and good luck studying, and I will see you soon.